Yes, hello guys, welcome to our financial reporting under IAS 40, IAS 1, preparation of financial statements. So let's analyze the questions as I said. Yes, let's see the first question that I've actually shared. So if you have not received, kindly ensure that you get the question so that we all move together. So read the question. The question says, the accountant of Wilson Company has prepared the following list of account balances as at 31st December 20x7. They have put their rounding off in thousands. We have 50 cents ordinary shares fully paid, 450. 10% loan notes secured, 200. Retain earnings 1st of January 20x7, which means these retained earnings are for the previous year, so they are brought forward to this year. Then we have general reserves 1st of January 20x7. This also balance brought down. And remember, they fall under a statement of changes in equity. Land and building 1st of January 20x7 at cost. Then plant and machinery 1st of January 20x7 at cost. Then we have accumulated depreciation there, which means for the previous years, not for this year. We have the building there, 1st of January 20x7. 1st of January 20x7. Then we have plant and machinery 1st of January 20x7, and we have inventory 190. Sales there we can see, purchases are there also. We have ordinary dividends paid. We have also loan notes interest. We have wages and salaries. We have light and heat, sundry expenses, suspense account, trade accounts receivable, and trade accounts payable. Then we have cash. Then we have notes. We have notes also. Notes there are given from A to H. A to H. Then we have another question. Another question also. It is from the same notes. This other question is also stating that the accountant of Fiddles Company, a limited liability company, has begun preparing final accounts, but the work is not yet complete. At this stage, the items included in the list of account balances are as shown below. We have the land, buildings, plant and machinery, depreciation provision, ordinary shares of 1 shilling, retained earnings brought forward. We have trade accounts receivable. We have trade accounts payable. We have inventory. Then we have profit before tax. We have allowance for receivables. We have bank balance as an asset. Remember, if they say an asset, you treat as a current asset. If they say bank balance liability, it is what? A bank overdraft. Then we have a suspense account there given as 1 shilling, 1,000. Notes from 1 to 5 below are to be taken into account, meaning that any balance carried forward that we have just read here will be affected by the additional information from 1 to 5. So let's read now. Roman 1. The accounts receivable control account figure, which is used in the list of account balances, does not agree with the total of the sales ledger. So, which means that when they were doing now posting, the accounts receivables and accounts payable were not balancing at all. Why? They are saying there was a contra entry of 5,000 has been entered correctly in the individual ledger accounts, but has been entered on the wrong side of both contra accounts. So then they are saying on the same, a batch total of sales 12,345 had been entered in the double entry system as 13,345. Instead of 12,345, they have overstated the figure. Although the individual ledger accounts entries for the sales were correct, the balance of 4,000 on the sales returns account has inadvertently been omitted from the trial balance, though correctly entered in the ledger accounts. That statement means that there was an omission. So that is why there was a suspense account. Roman 2. A standing order of receipt from a regular customer for 2,000 and bank charges of 1,000 had been completely omitted from the records. Roman 3, a receivable for 1,000 is to be written off. The allowance for receivable balance is to be adjusted to 1% of receivable. 4. The opening inventory figure had been overstated by 1,000 and the closing inventory figure had been overstated by 2,000. 5. Any remaining balance on the suspense account should be treated as purchases if a debit balance and as sales if a credit balance. Required A. Prepare journal entries to cover items in notes 1 to 5 above. You are not to open any new accounts and may use only those accounts included in the list of account balances as shown as given. Meaning, don't add any account. B. Prepare final accounts for internal use within the limits of the available information. For preparation purposes, all the items arising from notes 1 to 5 above should be regarded as material, meaning it will affect our figures as shown. So therefore, let's work out on the question. Question 1A, journal entries. Journal entries, you need to have the credit and debit. So we have the credit here and we have the debit here. So they are in thousands, correct? They are in thousands. So journal entries. From additional information 1 to 5, we want to factor them here. Now let's see. Additional information number 1. The accounts receivable control account figure, which is used in the list of account balances, does not agree with the total of the sales ledger. A contra of 5,000 has been entered correctly in the individual ledger accounts but has been entered on the wrong side of both control accounts. So therefore it means instead of debiting trade receivables, they have credited. Instead of crediting trade payables, they have debited on the wrong side of that particular. So this one is called error of original entry. This error of original entry need to be corrected. How do we correct? Already on the debit side of them, on the debits, they have put the trial payables on the debit side instead of credit side. So therefore, debit. They have also put 5,000 on the credit side of the receivables instead of debit side of the receivables. So therefore, 5,000, 5,000. Correct it. You will again work it using what? 5,000. Instead of now using 5,000 twice, you can just multiply 5,000 times 2, you get 10,000. So this 10,000 will be affecting both sides of the accounts. That is trade receivables and trade what? Payables. In this case now, this is how it should be done. Roman 1. You debit your trade payables with the 10,000. Then you credit your trade receivables. I'm saying you double it because once you have corrected by putting 5,000 to the correct side and 5,000 to the correct side, you are supposed now to come and do another 5,000. So instead of you doing twice, you just multiply, you get the 10,000. So you put debit side 10,000. You are reducing the trade payables. Then you are also reducing your trade what? Receivable. So what is the narration here? Being the correction of error from original entries. Correct. So you finish. On the same number 2, a batch total of sales of 12,345 had been entered in the double entry system as 13,345. Now, when you look at the question itself, we have been given profit before tax. So which means profit before tax has been overstated. Correct? By, you take 13,345 minus 12,345, you remove it. On this note now, how would we reduce that from profit before tax? You debit. Debit profit before tax with 1,000. You are reducing that. Then you are crediting your trade receivables, because that is now the problem. The debtors are reducing by the same. So what is this now? You can now say this is what? The error, being the correction of error on original what? On original entry. You underline. We continue. The balance of 4,000 on the sales returns account has inadvertently been omitted from the trial balance, though correctly entered in the ledger accounts. So in this case, they are saying there was sales returns. Sales returns automatically affects your sales and your debtors. In this case, there was total omission. And because it was omitted, it means the profit before tax of 80,000 has been overstated again. So therefore, we need to correct that. And that reason, for us to correct that, you need to correct your profit before tax and also correct your suspense account. That is why you have that 1,000 in the question. So you debit your profit before tax with what? 4,000. Then you credit your suspense account with 4,000. Then this is being correction of the sales returns that were omitted. We have the last part that is also attached to it. That is additional information 1. So also we go to additional information number 2. Additional information number 2 says, a standing order of receipt from a regular customer of 2,000 and the bank charges of 1,000 have been completely omitted. So they are not there. So therefore, the bank balance shown there as 12,000 is understated. We need to add. So we now say debit. How do we add bank? You debit. So debit bank balance with how much? 2,000. Correct? Then it is affecting which account? You have debited then. It's affecting what? Our trade receivables. Trade receivables. How much? 2,000. Then you say your narration will be being the correction of amount of money that was omitted and yet it has been actually been paid by our customer by the name. We don't have the name, but under trade receipt. So being the correction of direct receipt. Then we have also been told there was also a bank charges of 1,000 that was also omitted. So bank charges means that it would reduce our profit before tax. How do we reduce profit before tax? By debiting. So profit before tax, you debit that by 1,000. Then you credit your bank. This bank balance here is also overstated by that. So now you say correction, being correction for bank charges omitted. Being correction for bank charges omitted. Additional Roman 3. Roman 3. The opening inventory figure had been overstated by 1,000. So opening inventory meaning it is affecting both balance retained earnings brought down and the profit before tax. So it was overstated. Therefore it means retained profit brought down is overstated. So now we say you debit your retained earnings brought down by how much? 1,000. Then you credit profit before tax 1,000. So now say being correction, being the correction on stock overstated. So at the beginning it means that profit brought down is overstated by 1,000. Then it means that when you now bring into the current period, that is now the current period which is giving us profit before tax, that 80,000 you are seeing in the question is also small, so we need to increase. Then on the same note, you have also been told that there was also overstated what? Understated inventory. Now, understated inventory meaning it is affecting our closing inventory, but this one is affecting our opening inventory. Therefore, it is affecting our opening closing inventory. In this case, closing inventory is 180, 190, which means it has been understated. Increase it. So we're now saying inventory here by 2,000, increase 2,000. Then it means that the profit brought down, profit, not brought down, but profit for the year. Profit before tax is also understated, so you increase. And then you are through with that. Then we go to number 5. That the opening event, number 5, any remaining balance on the suspense account should be treated as purchases if a debit balance, and as sales if a credit balance. When you go to the question, a suspense was 1,000, correct? Or 1. In this case, on the suspense account, it is 1,000. Now look at what has happened here. We have credited the suspense by 4,000. So we have credited the suspense by 4,000. It means that there is an increase in terms of suspense account by 3,000. Therefore, this is how it has been done. That if, for example, we open the suspense account, here we can say balance brought down is 1,000. Then we have the correction. You look at this correction here. Okay? We have the profit before tax of 4,000. Now, we have to balance this one. We have been told the balancing figure. If the balancing figure is a debit, take it as purchases, which means it will affect your stock. If the balancing figure is a credit, take it as what? Sales. Let's see now. So here will be carried forward as what? 3,000, so that now you get your 4,000. So you are told under financial accounting 1 that if a carried forward is here, brought down is here. Correct? Therefore, it is now the credit balance. Credit balance treated as what? Sales. So therefore, we record that number 5. So 1, 2, 3, 4. Number 4. I think this is number 5. I've skipped number 3. So I will work out on that number 3. So this is number 4. So this one now, you now say yes, this 4,000 has been omitted. So what do we do now? This 3,000 here. So therefore you now say debit your suspense. Then you credit your profit before tax with 3,000. Then we go to number, I skipped by mistake, number 3. Let me go to number, this is number 1, Roman 1, Roman 2. So this one is Roman 4. This is Roman 5, so let me go to Roman 3. Sorry for skipping that. Roman 3 says, a receivable for 1,000 is to be written off. Receivable of 1,000 is to be written off. So written off receivables is an expense, so it will affect your profit before tax. Then you do what? It will reduce now your payable, your receivables. So in this case now you debit your profit before tax by 1,000. Then you credit your trade receivables by 1,000. Then they are saying in this case also, continuation of the same, that the allowance for receivables balance is to be adjusted to 1% of the receivable. So they are providing additional allowance on the receivables. From the question, we have been given allowance for receivables as 3,000. Here they are providing an extra 1%. So the reason why they are providing another allowance is for you to compare the opening allowance and the current allowance to see whether there is any increase or decrease. Now, according to FA1, Financial Accounting 1, you are told if there is any increase on provision of allowance, increase is treated as what? An expense. If there is any decrease on provision decrease, you treat it as what? Income. So we want now to see what will happen with that note. So let's see 1%. Therefore, we are being forced now to prepare what we call receivables account so that now we get the balancing figure. So for that note, allow me to work out what is up here. Let me wrap somewhere here so that I prepare it from there. Yes. So I'm working out on that additional information number 3. So let's see now. Trade receivables. How much is the balance given from the question? Trade receivables balance given from the question is 200. Correct? This 200 has been affected by the journal entries here. So let's see what is happening. There is additional information number 1 that is saying, you see all the receivables are debited. If we say credit, it is reducing this. If we are debiting, it is increasing receivables. So let's see. Roman 1, trade receivables is on the credit side. So we can now say, yes, there was a problem here. And that problem was on contra. Contra of 10. Correct? We have also trade receivables of 1,000 or 1 here. The problem was, that is additional information number 1. The problem was addition, that is error. There was an error of 1,000. I can also see, I don't see it here, I'm seeing it here, bank, that there was a payment, direct payment of how much? 2,000. Then I can see, I'm not seeing it here, I'm not seeing it here, I'm not seeing it here, but I'm seeing it here again. Another credit of how much? So this 1,000 is for what? Written off, eh? The one that was written off. How much? 1,000. Correct? Now, any other? So if there is none, let's now work out. So if you work out this one, you'll get 186. 186 balance. Now, we have been told provide 1%. So, allowance 1%. 1% of this. 1% of this is 1.86. This 1.86, compare it with the one shown in the question. The one shown in the question is 3. So therefore, is it an increase or a decrease? It is a decrease. Any decrease on provision on allowance is an income. So therefore, by how much? By how much? So let me work here. So balance brought down is 3. Then provision 1.86, 1.14. So therefore, it is there was an increase of this. So this is an income. So therefore, it means for that note, we are supposed to debit our allowance by 1,140 if you go by thousands. Then you credit your profit before tax of how much? 1,140. So that is how you are supposed to show journal entries as per question A. So let's now go and prepare the financial statements. Financial statements here, we are talking about profit, correct? Profit or loss. Then statement of changes in equity. We are also supposed to show statement of financial position. So let's now see. Correct? So let's now see. So you have been told prepare the financial what? Statement. Now on this note, before we do that, we need to show some workings. Already working number 1, we have already done. We have already done on receivables. So let's do some computation. Now according to the according to the additional information given, the information given actually was affecting also the figures or the figures on your question. So let's see, for example, retained earnings brought down. Okay, so let me start with the retained earnings brought down, or let me start with the accounts receivable. Let me just repeat accounts receivable. Working 1. How much was the balance brought down? Balance brought down there was 200 or 200,000. Correct? Then there was a contra. You remember the contra that we have just done on our trial balance? 10,000 on the debit side, on the credit side. There was also a miscalculation. That is miscalculation or error. We have an error of 1,000. Correct? There was also a problem with the standing. There was a payment that was made due to standing orders, which is reducing. There was also amount that was written off. Remember, 1,000. So once you do that, you add, you get your figure 186 what? 1,000. This figure here. Now allowance here, we have been told allowance is 1%. 1% gives you 1,860. Now balance brought down here, there is a balance brought down of 3,000. Now is it an increase or a decrease? So you can now say decrease, which is the balancing figure, which we have found to be 1,140. So this one we have already used it somewhere, and we are going to use it also. Another working should also be profit brought forward. Working number 2 is profit brought before tax. Profit before tax, the balance was how much? 80,000. There were transactions that affected this. The first one was sales error. Sales error. You remember 1,000? This one here. This. There was also a suspense account on returns. Returns, which was 4,000 in the suspense account. We have also found there was bank charges that were omitted. Bank charges, 1,000, they were omitted. Then we have also bad debts written off, 1,000. Bad debts written off, 1,000. And there was a decrease in what? Allowance, which is an income. So it is a positive like this. Then we have inventory. They were increasing this. There was 1 plus 2. You get 3,000. Then there was also suspense, which if balancing figure, we are told if it is credit, you add it here. So the final figure, when you work it well, you will get 80,140. Correct? Now, we have also what they call the profit brought down. You remember the profit brought down? Profit brought down, there was a problem of 1,000 only. So you can now say, okay, number 3, profit brought down. Balance was how much? From the question, balance brought down was 380,000. Unfortunately, there was a problem with 1,000, right? You remember? This is our overstated stock. So this will give you 379,000. Now, what else that need to be worked on? What else need to be worked on is depreciation, PPE. So working number 5 for PPE movement schedule. So we have the total there. What else do we see here? I'm seeing land. I'm seeing building. I'm seeing plant and machinery. Correct? Then balance brought down there. Land is 1,000 or 100. Land is 100 or 1,000. Building is how much? 120,000. Correct? 120,000. Then I have plant at 170,000. Then there is a depreciation. In this case, we have been given depreciation as depreciation from the question. Was there any depreciation given from the question? No, there is none. I think there is none. So we don't have. Then you add, you get the figure as. Any depreciation from the question? Yeah, there is 120, which is purely affecting 120. So I think it is affecting this one. So how much is the net book value? If you work out that, you get 270. So depreciation, you get here 50,000 here. You get here 120,000. You get here 100,000. So if you add, you get how much? 270,000. So this is what I will transfer to our PPE. So I'm through now. So let me prepare. First one is to prepare income statement. What is the name of the company? It is called Fidelis. Fidelis company. Then statement of profit or loss for the year ended 31st 31st December 20x7. Then you can deal with thousands, shillings there. Was there profit brought down? Yes, profit brought down. Profit brought down we have already worked out and found to be here. No, profit for the year first. Profit for the year, profit for the year. Profit for the year is how much? 80,140. Profit brought down. Retained earnings brought down. There is a problem affecting that profit. It is here already worked out. 379,000. Add 0.14954. So that is how it was to work out that. So there was no much transaction for that. So let's go to now statement of financial position. Statement of financial position. Statement of financial position, which is a bit large. So statement of financial position. So it's called Fidelis company. Statement of financial position as at 31st December 20x7. So we have assets here. Then we have non-current assets. So non-current assets, we have the PPE. We have calculated and found to be 270,000. Was there any goodwill from the question? There was none. Completely none. Then we have the current assets. current assets. What do you see there? Inventory. We have 90 plus 2. That is 92,000. First column. Then there was also bank. There was account receivable. Accounts receivable. Accounts receivable we have found to be 186,000, right? Out of this 186,000, there was allowance for that year, not for the previous year, for that year. We found it to be 1,860. So if you subtract that, what do you get? You get 184,140. Then there was bank. Balance brought down from the bank we found to be 12. Then there was a payment of, there was a receipt of 2,000, and there was a bank charges of 1. So your answer is 13,000. Correct? Now when you try to add this one, you transfer here, you get 389,140. If you add now current non-current assets plus current assets, your answer is 659,140. So that is your total assets. Total assets. Then we have equity and liabilities. Equity. Equity we have what? Do you have share capital from the equity? Do you have share capital? Yes. So it says share capital. How much is share capital, class? 100,000. Then there was retained earnings that we have just calculated, the adjusted figure. We found it to be what? 459, 459,140. Then we said you add this so that you get 559,140. There was nothing else to be added. Then we have, there was liabilities now. Liabilities. Liabilities, there is only one, current liabilities. So you write there current. So which current is that? Payable, right? Payables. Payables. In this case, there was 110,000, but there was a contra-entry error of 10,000. So you subtract 10. Your answer is 100. So you add here your 100. So total here is 659,140. So this is total. This now you get your total equity and liabilities. So you can see this figure is balancing with that. So it means you are accurate in terms of computation. So this is how you are supposed to prepare your financial statement based on example 1. So I'm going to now start example 2. Welcome and continue enjoying lessons.